talk. First and foremost, thank you for coming. Appreciate it. Despite the crappy weather, I appreciate you coming. This is actually our first event we've done since COVID in this space. We're doing one tomorrow too, Matt, 8 a.m. So I'm super excited to. Well, number one, I'm super excited to see you all in person. It's great. And you can sit down right here. And super excited to have this speaker. As many of you know, we are believers in technology investments, and specifically disruptive technology. And I got to meet these folks 4 years ago, and it was kind of the first time I heard them talk in person. It was almost hard to believe, understand, comprehend. But then as doing our research and paying attention, we really became believers ourselves in what they're doing. So I'm going to introduce my relationship and let Jay introduce everybody else from ARC. But this is Jay Schilling, who's National Sales Manager for ARC. He actually has been there since day one, and his team actually found Kathy Wood, identified her and brought her in. And so he has a long history, and we were talking in Aspen, your favorite place in the world, Brian, and about doing an event. We're just so huge believers in this that I wanted you guys, I feel like we're cheating you, because I hear what they're doing and see what they're doing, and I don't translate it well back to you. And so these guys, you're going to hear it directly from them. So
we're happy to do plenty of these.
Yeah.
So thanks, Randy. Jay Schilling. Joined by my colleague Doug St. Myers in the back. Doug's more the local relationship manager. He's in Worthington. I'm in New York, but I'm here all the time, traveling with Doug. And then we're also joined by Ryan Hodap. So Ryan Hodap is our ARC investment specialist today. So Ryan has had a long career in manager research and portfolio construction. He's been an excellent resource for us. He's going to run through the presentation. I'm just going to wind him up and let him go here. If you have burning questions, seriously, please feel free to ask. We're going to leave some time for Q&A. Typically, this presentation does have, does elicit quite a few questions, so please feel free. We're going to kind of customize to the main topics that we think is most important. But ARC really spans 5 general purpose technology platforms, and there's 14 underlying technological themes that funnel up into those 5. Ryan's going to cover that, but we're going to focus on electric vehicles and autonomous vehicles. We're going to focus on artificial intelligence and the whole genomic revolution that's happening. But we're really psyched to be here. Thank you, everybody. Go ahead.
One thing I did ask him to do that's different than normal, I think, is this last time when I was out there, one of the things we talked about, and I saw firsthand, is their process, the investment process. And in my experience, the way they select stocks is very different than every other manager out there.
Yeah, and then thinking about the way ARC and Kathy Wood founded this firm is the focus to solely on disruptive innovation. But we would also say on the investment side is they're almost disrupting the way that buy-side research is done. From an asset management standpoint, and Ryan's been at big traditional asset management firms, Bank of America and Waddell & Reed and USAA, and there's a different way that Kathy Wood and her team has approached the way that investment research is done. So on day one in 2014, that's when the firm was founded. We came on board in 2016 and represent ARC, have a minority stake in ARC, and that's when we thought that this was so differentiated and so unique. And with that, I will let Ryan cover the agenda, and thank you everybody for being here.
Thank you, Jay. Good evening.
Good evening.
Okay, there we go. I'm just making sure. Only one beer, dude. Come on. All right, so I'm Ryan Hodap. I'm the ARC product specialist. Yeah, the agenda is quite simple. I'm going to hit on 2 big picture topics today. I think Randy teed up the important one. I'm going to start just spending a couple quick minutes at the outset talking about ARC's overall investment approach, because I think it's good to have kind of a baseline understanding of how they do what they do. Then we'll get to the good stuff, which is what we call big ideas, which is sort of the culmination of all of ARC's research. And that's where you're going to hear a little bit more about the individual technologies that ARC is researching. See if the clicker's working. We're good. Okay, so there's 3 things as I think about talking about ARC's investment approach that I want to touch on. I want to talk about their research infrastructure. I want to talk about some kind of big picture macro factors that they find important. And then I'll finish up with some kind of company specific metrics that their analysts also look at. For those of you not familiar, to launch into the research infrastructure, so ARC was founded a little over 8 years ago by Kathy Wood, and you heard it, Kathy is an innovation enthusiast. And because she has this great passion for all things innovation related, everything that ARC does centers around identifying disruptive innovations. Now Kathy's supported by Brett Witten, who's ARC's Director of Research, and Brett is the quintessential MIT genius that somehow seems to know a little bit about everything. It's mind-boggling if you ever listen to the guy talk. Now we're going to start to get into one of the notable differentiators, and that is the analyst group that is supporting both Brett and Kathy. One of the things that ARC does that's pretty different relative to the industry is when we're hiring analysts, we don't tend to hire people with traditional finance or investment backgrounds. Instead, we tend to hire people from industry, from the actual industries that they are covering. So, for example, our genomics analysts, Ali Ehrman and Simon Barnett, they have backgrounds in cancer, oncology, clinical research. Our thinking is it's much easier to teach someone like Ali, like Simon, to understand a balance sheet, an income statement, et cetera, than it is to take a finance analyst off the street and teach them to understand CRISPR-Cas9 gene editing therapies. It's a completely different ballgame when you start to get into the depth of the science and the technology. So number one, we hire from industry. Number two, ARC's research ecosystem is very open in that ARC tends to share most of their research, which you don't see many firms do. If we've thought about a topic, if we've researched a topic, invested in a topic, first of all, we've either got a white paper, a blog, a podcast out on arc-invest.com. We have our actual financial models for Tesla and Block, formerly Square, out on a website called github.com. And then our analysts are often interacting on Twitter, of all places. They're posting their thoughts on the technologies, basically in an effort to interact with venture capitalists, entrepreneurs, academics, etc. The reason that we're putting all of our research out in the public domain in that way is we want to hear from those venture capitalists, those academics and entrepreneurs, where might we be wrong? Where might we be wrong? So we think by putting that out there in the public domain, we're going to get more of a 360-degree view of how we're looking at the world, and that makes our research process that much more robust. So there's the research infrastructure. Next up, we've got, I mentioned I'm going to talk about two top-down macro factors that are important. Two things here, they look at total addressable market and something called Wright's Law. So we're going to start to get pretty nerdy here in a minute. Total addressable market, what is that? We want to know just how big could this opportunity be when we are looking at these technologies. So for example, and you'll hear this a little later on, as we look at the electric vehicle market, we think there's going to be 40 million electric vehicles on the market in 5 years. Once we kind of size the market, we can assign a revenue pool to that to understand how big that could be. Then we work our way backwards. Who might be the leader? What kind of revenue can we assign to that company, et cetera, et cetera. Second, on the big picture, Wright's Law, our friend Wright's Law. What Wright's Law says, and this is a centerpiece of ARC's research, you're going to see it several times later on. What Wright's Law says is for every cumulative doubling in units produced, so 2 to 4, 4 to 8, 8 to 16, for every cumulative doubling in units produced, you tend to see a nice linear or fixed decline in costs as we look at these technologies. We found Wright's Law is a very accurate way of forecasting costs and the direction of falling costs. The reason we're looking at all these falling cost curves is as we roll down those cost curves when we look at these technologies, you eventually get to a point where there's a very powerful tipping point and you sort of see a hockey stick in demand. So that's a critical part of their research. All right, last stop here before we get into the technologies. I want to talk about the 6 underlying company metrics that ARC's analysts look at. And you can see them all up here. What our analysts do is they rank stocks on a 1 to 10 basis, 10 being the highest, across those 6 metrics. And those rankings ultimately lend themselves to what extent we do or do not have conviction in an individual company. So the first one you see up there, company, people, culture. Here's where we're spending a lot of time with the C-suite, the execs. As innovation-based investors, we're often dealing with some very visionary leaders. And then I'd say the other important thing when we're looking at personnel, we want to understand the R&D staff, research and development, because as innovation-based investors, the last place we want to see a bunch of departures would be from research and development. Speaking of R&D, that brings us to the second step, which is execution. With execution, we just want to make sure that our companies are spending appropriately on R&D. And to sort of turn that on its ear, what we don't want to see, we don't want to see companies leveraging up their balance sheet and just using that capital to buy back stock or pay it out in the form of a dividend just to appease shareholders short term. We want to see our companies reinvesting in the business. Next up, moat, barriers to entry. Here what I would tell you is we spend a lot of time just trying to understand what the competitive dynamics look like across these technologies, across these industries. So sticking with electric vehicles, if Tesla is the market share leader, we've got these entrants like Lucid and Rivian, as well as big companies like GM and Ford. What might that mean for a company like Tesla? 4, product and service leadership. Two big things we look at here, brand strength and market share. We obviously want to see those trending in the right direction. Number 5, valuation. Here, before any stock can make its way into any of our portfolios, based on the valuation work that our analysts do, a stock has to have a minimum annualized expected return of 15% per year over the next 5 years. So 15% annualized over the next 5 years, which equates to a doubling over the course of 5 years. That is our minimum threshold. And then last but not least, thesis risk. With thesis risk, we just want to make sure that the geopolitical environment and the regulatory environment is a tailwind and not necessarily a headwind. And to give you a real-world example of where it recently became a headwind and it actually led to a sell decision, we had some decent exposure to China in the middle part of last year. And as you may have seen, the Chinese administration went through a whole series of crackdowns. They cracked down on technology companies for privacy data issues. They privatized the for-profit education companies, and they said kids can't play video games more than 3 hours a week, which would drive my 17-year-old son nuts. Anyway, there was just this string of events, and it just didn't seem like there was any end in sight. At heart, our portfolios are concentrated, conviction-weighted portfolios, and if our conviction wanes to any notable degree, we would rather redeploy those assets elsewhere, and that is exactly what we did. All right, before I get into big ideas, any questions on the investment approach? Going once, going twice. Okay, this stuff's more fun anyway, I promise. Okay, we're going to get into big ideas now. And big ideas is this big deck that is sort of the culmination of all of ARC's research, and in particular, where they're seeing the most advancements in 2022 and beyond. So this is where we're going to talk about those 11 to 14 technologies that Jay mentioned. Now, before I get into those individual technologies, let me set the stage for the broad opportunity set that we see in innovation. Jay made passing mention of 5 general purpose technology platforms. You can see those across this page. So artificial intelligence, battery technology, blockchain, robotics, and gene sequencing. That's the big picture areas where we are tending to traffic, where we're spending most of our research time. If we look at the combined public market value of that basket of innovation, it's worth about 10 to 15 trillion in the markets today. Based on ARC's research, they think that can grow to 210 trillion by 2030. Now, it was not that long ago that 210 number was only, big old air quotes, only 75 trillion, like a year ago. And it begs the question, like, why are the numbers getting even higher? 2 very important factors. Number 1, all we are seeing is costs fall across these technologies. We're seeing the cost of batteries fall that go into electric vehicles. The cost to train artificial intelligence models is falling. The cost to map the human genome has fallen precipitously over the past several years. And I could go on, and you're going to hear more about this later on, but all we are seeing is costs fall across these technologies, number 1. And number 2, it's a messy chart over there, we are seeing these technologies converge. And what I mean by that is these technologies are just becoming more and more interrelated. They're feeding into each other. So AI is being used in autonomous vehicles. 3D printing is being used in the aerospace industry, et cetera. So we think it's this confluence of both falling costs as well as the convergence factor that's going to lead to some really strong consumption in the future. That is why we are so bullish on the overall innovation space. So that is the 30,000 foot view. Get back to the agenda page here. Okay, there we go. All right, now we're going to get to the really good stuff. So I think Jay teased it. So we're going to do a couple things here with the rest of our time. We're going to do a deeper dive tonight on 3 technologies: artificial intelligence, digital wallets, and then electric vehicles. But before I do that, I do want to give you a few quick sentences on the other ones, just so you have a sense for what they are. And then if you do have any questions on those, I'm happy to take those as well. All right, so the first one after AI, we've got digital consumer. What we tend to talk about in this particular section is if you think about the amount of how we spend our free time, I guess, how we spend our free time, it's something like 62% offline, 38% is online. ARC thinks in the next 10 years, those ratios are essentially going to invert, where we spend more than half of our time online and less than half offline. And it just speaks to the increasing digitization or digitalization of our economy. What that ultimately means is it's going to be very constructive for e-commerce, online advertising, as well as video gaming. Web3. What is Web3? Here's where we talk about the verifiable ownership of digital goods. It's the weirdest sentence in the world. The verifiable ownership of digital goods. You may have heard about this nascent concept. It's called the metaverse, where we're going to be living in these virtual worlds. You know, it's going to take us a while to get to Ready Player One, if you've seen that particular movie, but we're going to be more and more virtual in terms of how we do things, and it's evolving from the video game industry to now people in the Philippines are playing video games and getting paid to do so. So this speaks to concepts like NFTs, if you've heard of that, just sort of crypto adjacent, non-fungible tokens, where you have verifiable proof of ownership of a digital piece of art. So those are the types of things we talk about in Web3. All right, gene editing, multi-omics, I want to lump that together into something we call the genomic revolution. And I do want to spend a couple extra minutes on this one, because I do think it's really important, and it's a big, big opportunity. So as you look at the healthcare sector as it stands today, it's all about treating the symptoms. Well, what if instead of just treating the symptoms, we A, could uncover markers for disease at a much earlier stage, because our genome does actually mutate, and B, what if we could come up with some therapies that might actually be curative, some functional cures? So if we look at the first part, getting our arms around those markers for disease in an earlier stage, 2 things we look at: what's called long-read DNA sequencing and then multi-cancer screening. Long-read sequencing is exactly what it sounds like. It is a longer read of our DNA strand, so we can get a much more accurate analysis. All right, here's where we're going to start talking about falling costs repeatedly. This is one of those innovations that's very much been driven by falling costs. If you go back to the original Human Genome Project back in 2003, it cost $2.7 billion to map the human genome. That is now sub $1,000, and it is getting cheaper from here. And there was some exciting news in this space, by the way. I don't know if you saw this past week. There was a small subset of the human genome that had not been mapped yet, and we finally got the rest, that final like 8% gap. And that is, again, that's going to help us uncover those markers for disease and lead to better diagnoses. Second, multi-cancer screening. Also exactly what it sounds like. It's the ability to screen for upwards of 40 different types of cancers with a really non-invasive liquid biopsy. You know, when people have cancer, unfortunately, they often don't know until they show symptoms, which is stage 3, stage 4. What if instead we could find it earlier, around stage 1 or so? Another innovation that has everything to do with falling costs. A prototype, is there a question?
I was going to ask about stem cell, but
that is a part of the research, and I think that's being used more in kind of the cell and the gene editing and gene and cell therapy. But yeah, it's used to be such a kind of controversial topic, and we're talking like 20 years ago. And now they're finding that these cells can be used for all kinds of different therapies. The whole, and I'm going to get to it in a second, because I'm just going to talk about CRISPR, but there's things like CAR T cell therapy and all that kind of stuff. It's super, super exciting. So anyway, multi-cancer screening, also falling costs. Prototype was like 30 grand like 5 or 6 years ago, also down to like $1,500 and getting cheaper from here. The big innovation there is the most simple thing, in that it's liquid biopsy. That is the new innovation in this space, i.e. a blood draw. Because if you think about most cancer screening right now, it's like colonoscopies and liver biopsies and all these just really invasive processes. If we could just make it blood draw, we could make it a part of our normal annual routine and checkup, and that could save upwards of 66,000 American lives each year, and that's just in the US. All right, last but not least, so thinking of creating cures and functional cures, this is when we get into gene editing and things of that nature. The big innovation is something called CRISPR-Cas9. Have you guys heard the term CRISPR kind of floated around a little bit? Seen a few nods. I'm not a geneticist, but I do play one on TV, so I'll describe it as best I can. Imagine a spot on your genome where there is something wrong, something broken. With CRISPR, what you do is you send an enzyme into that spot on your DNA, it clamps on, and then it acts like a literal DNA scissors, cuts out the bad stuff, brings in a bridge to right the ship. This is an area where we're seeing all kinds of exciting stuff going on. It's being used to basically create some functional cures for some sort of rare blood-borne diseases, so things like beta thalassemia, sickle cell anemia. Unfortunately, people that have those types of diseases often have to have multiple blood transfusions per year, another invasive process. Well, I've heard there's one patient that with a single CRISPR dose has gone something like 2 years without a single blood transfusion. So what's so exciting to me about this space is it's not only about saving lives, extending lives, it's also about improving the quality of life. So a lot of exciting things going on in that genomic space. Oops, sorry. Okay, next up, autonomous ride hailing. So with autonomous ride hailing, I'm going to steal one of Jay's lines. This is one of those innovations that comes across as being the most far-fetched, because we're literally talking about robotic taxis with no human drivers. I'm here to tell you this is one of those innovations where science fiction has already become science fact. There is a company out in the Phoenix area called Waymo, which is owned by Google, and they have already logged 30 million miles. And they are getting ready to do a pilot in San Francisco right now. This technology is already here, and it's going to be transformative just for our economy, for how we get around. It's pretty fascinating stuff. Might lead to insurance rates going up too. Autonomous logistics. There's 3 technologies we tend to talk about in that particular section. There is autonomous trucking for shipping. There is the ability to use rolling drones to bring you groceries. One of my colleagues was giving a similar presentation last week, and he ran into a financial advisor who said that advisor was taking their daughter on a college campus tour, and on college campus they literally saw one of these rolling drones, and it looked like it had like a series of coolers behind it. There is rolling drones on a college campus bringing college kids food. It's already here. And then the last one is flying drones. That's going to help both e-commerce as well as, even if you live in like suburbanite areas, things like your DoorDash. Imagine if you could just hop over the town and drop it right on your lap. And that's one of those innovations that's going to continue to grow as batteries get cheaper, the batteries get more powerful, but it's going to be all about low costs. 3D printing and robotics. With 3D printing, that's one of those innovations that's still somewhat in its nascent stage, mostly used for prototyping right now. But there are some really interesting long-term scenarios where 3D printing is already starting to make sense and will continue to make sense. One big one would be the aerospace industry. Imagine if you're an aerospace manufacturer and you're looking to save money, you could use 3D printing to create some complex, low-volume parts, because that's what 3D printing does very well, complex, low-volume parts. Well, the interesting thing is not only will that save the aerospace manufacturer money, it will also save the airline that use those jets money as well, because that material is lighter and it's going to therefore be more fuel efficient. With robotics, one of the big things we tend to talk about is there's this big misnomer out there that when companies deploy robotics and automation, everybody and their brother's going to lose their job. And it's just not true. The reason being is companies that tend to deploy robotics, that tend to deploy automation, they end up being more profitable. They have stronger cash flows, stronger margins, a greater degree of productivity. And because they have this greater degree of profitability, they are in a much better position to retrain their employees for better, higher paying jobs. It is exactly what Amazon has actually been doing over the past couple of years. It's not job replacement, it's job substitution. All right, last but not least, before we get into our big 3, orbital aerospace. This is a fun one to think about in that we have a renewed space race between a few billionaires. We've got Richard Branson, we've got Elon Musk, And Jeff Bezos just took Captain Kirk himself, William Shatner, up into space, which is something I never thought I'd see in my entire lifetime. Yeah, so that happened. So we've got a renewed space race. That is fun to think about. That is exciting. And we are going to continue to watch how commercial space flight progresses. In the meantime, we're interested in something else. What we're looking at here is the ability to get more people around the world broadband internet access by getting more satellites up into space. Believe it or not, there are still 3 billion people around the world who do not have broadband internet access. 40 million of them are here in the US. Now, and this has to do with lower cost too, now because rockets are reusable, I think the Falcon 9 has gone up and down like 16 times now, rockets are reusable and satellites are smaller and foldable. We're going to be able to get more satellites up into space, and we're going to create sort of a low Earth orbit mesh network, and that's going to help those people in remote areas also get broadband internet. And then think about the global economic growth impact that could lead to as well, which is pretty powerful. All right, that's kind of the setup. Now we're gonna actually do more death by PowerPoint. Okay, let's get to AI. Okay, there we go. Okay, artificial intelligence. It is, there's a reason that this technology is first, and it is not due to alphabetical order. This is far and away the biggest of big opportunities. As I like to think about it, AI is the ultimate convergence technology. It's the ultimate convergence technology because it's being used in so many different industries and sectors right now. It's being used in autonomous vehicles, as I mentioned. It's being used in your Alexa speaker. It's being used in your Netflix account. The more shows you watch on Netflix, their AI algorithm starts to pick up on what you like, and it spits back more other things that it thinks you will also like to keep you in the seat longer. And then just a couple weeks ago, the most recent example I saw, White Castle of all things, they are now going to start to use an artificial intelligence model in their drive-thru. So if you ever go to a White Castle around the country and you're ordering at White Castle, you might actually be talking to an AI.
By the way,
yes,
they're headquartered here, White Castle is, and the first one is here. I've never been to White Castle in my life. I've heard about it.
I may have gone at 3 a.m. when I was in college. No, it's funny, as a total sidebar, so they are an amazingly innovative company for just a fast food restaurant, because not only are they deploying AI, they are deploying a robot called Flippy. So Flippy's whole reason for being, it is a fully autonomous robot, is to make the best hamburger. We've got this worker shortage going on around our country, and so this robot is literally going to work alongside of the line chefs to make burgers. So now we have both a robot and an AI model at White Castle, which is really one thing. So with AI, here is our friend Wright's Law, and you see those arrows sloping down. Those are those falling costs I told you about. The big falling cost with AI is what we call AI training costs. In other words, sort of the software and hardware horsepower behind these artificial intelligence models. Based on Wright's Law, hardware costs are falling at a rate of around 39% over the next 8 to 10 years. With software, it's 37%. But when you aggregate them, AI training costs are expected to fall at a rate of 60% over the next 8 to 10 years. The reason we're talking about falling costs with AI specifically is as we continue to roll down that cost curve, it's going to help democratize the technology, and it's going to make it that much more available for different industries, for academics and others. Where AI is helping out, and this is why White Castle is using it, it is a productivity enhancer. So ARC believes that artificial intelligence is going to improve the productivity of what we call knowledge workers. You can see examples, software developers, paralegals, etc. It's going to improve the productivity of knowledge workers by 140% by 2030. Imagine if you're a paralegal and you have an enormous legal document that you have to analyze and parse through. What if instead you could turn that document over to an AI model and it spits back to you one paragraph that basically says, here's what you really need to do. No, that's going to make that paralegal that much more productive. They can go on to bigger and better things. And then I know, we've already talked about labor disruptions and things like that, but there is a worker shortage going on, and that's where AI can help as well. Imagine if you're a software company right now and you are struggling to hire and retain software developers. Well, there's an AI model called Codex. And think of Codex like as the Google Translate for coders. What Codex does is it translates English language sentences into code. So there's a silly example behind me. It basically says, make a red ball bounce on the screen. You type in that English language sentence, Codex will turn that immediately into code. It writes the code itself. So imagine if you're short-staffed as a software company, this would be a nice way to augment your existing software developers. And it's just wild to think that that actually works. Because AI is just such a big opportunity, it's going to improve productivity so much. Our overall expectations for information technology spending, IT spending, is much, much higher than the consensus. Right now, companies around the globe spend a little bit less than $5 trillion on IT, and the consensus expectation is that's going to be a little above $5 trillion by 2030. Our expectation is that it's going to be $15 trillion higher than that, mostly due to increased spending on AI software and hardware. And if we finish up with the investment opportunity in this particular section, it is enormous. This is the biggest of the big ideas. So if you look at the combined kind of enterprise value or market value for all the AI software and hardware companies out there, worth about $2.5 trillion today. ARC thinks that that may scale up to $87 trillion by 2030. What's really powerful to me on this particular page, there's this little dark purple bar here. That's the amount of wealth created by the internet. It's kind of changed people's lives, right? The internet has kind of created a lot of jobs, a lot of wealth. Imagine a technology that could dwarf the internet. This could be one of the biggest wealth creation opportunities that we have ever seen in our entire lifetime. That's a big idea. All right, let's go to digital wallets next.
Any questions on this part?
Yeah, we'll pause while we fast forward again.
Matt?
Was there a question? Yeah.
You don't have any excuses to say. I think it's, so I've written the technology that White Castle is using, not the specific one, but the equivalent to it.
Very cool.
And we do a lot of software stuff. I think we're a lot further out in one time horizon.
Mhm.
Some of the AI applications,
Yeah.
not all, there's some really good ones. But like the coding thing,
And that's not at 100% either. It's like 30, 40, 50,
we
60%.
might not really see
Yeah.
a lot of it.
Yeah.
There's others that I do.
Yep. GPT-3 is the other big powerful one. Because the other big innovation over the past several years is AI used to be more what's called vision-based, i.e. you could recognize pictures. Now it's much more language-based. So this other model that's language-based is called GPT-3. It has like 185 billion different parameters. And again, it's trying to take English language and turn it into code. So yeah, you got it covered. All right, digital wallets. What the heck is a digital wallet? So think of a digital wallet as a way to basically get banking services on your cell phone, a way to access financial services on your cell phone at a rate that's much cheaper than you might experience going to a traditional brick and mortar bank. Now, this is one of those innovations, you think about shocks to the system leading to adoption. The adoption was certainly accelerated due to the pandemic, because if you go back to 2020, sort of the heart of this mess, there were a lot of people concerned about transmission, and they didn't want to use physical cash. Some people didn't want to use physical credit cards and debit cards, and these digital wallets like Venmo, like Cash App, they filled an interesting unmet need. And in rather short order, you can see those green and purple lines. Companies like Venmo and Cash App now have in excess of 70 million customers. It took JP Morgan, one of the largest banks on the planet, to get to 60 million. It took them 30 years to get to 60 million. So they're growing very rapidly. Now, it's not just a COVID adoption story. There's a lot more going under the surface. One of the things that's really helping these companies grow is they have a much lower customer acquisition cost relative to the traditional brick and mortar banks. In other words, what does it cost to go out and get a new customer? If you look on those tiny lines off to the far left, it's anywhere between $1 and 26 bucks. With the traditional brick and mortar banks, it's anywhere between $750 and $2,500, much, much higher. Why is it so much higher for the traditional banks? Well, they often have to build out infrastructure. They often have to build out a physical bank branch to say, hey, I'm here. With Venmo, all you need is a cell phone, and it's not like Venmo is manufacturing these. Here's why this is important, this whole customer acquisition cost idea. there are thousands and thousands of customers out there that are sort of unbanked or underbanked, people who either can't or don't want to pay the fees that the big banks charge. And since the digital wallet companies have a much lower customer acquisition cost, they can charge much lower fees and still maintain a really strong margin. Now, let me give you a sense for how this business is growing and how we think it will continue to grow from a profitability perspective. Does anyone have a Venmo account in here, or Cash App for that matter? Okay, probably 2/3 of the room almost. What they're doing right now is they're hoovering up tons and tons of customers through the peer-to-peer payment system. So if you're not familiar with what that is, let's say Jay and I went to go to a rock concert together, tickets cost $200, and I gotta pay Jay $100. I don't have to get in my car, drive to the ATM, pull out $100 and send it to him. I press two buttons and send it to Jay, and we can go to our metal concert. They're hoovering up tons and tons of customers with this peer-to-peer system. As a side, one of the biggest time periods where there are new Venmo accounts, like new signups, it's when freshmen go off to college. Because the freshman goes off to college and they say, Mom and Dad, I want a really easy way for you to get me money. So mom signs up, dad signs up, maybe grandma, maybe grandpa. And then by the way, once they get to know their friends, they ask their buddy to sign up as well so they can send them beer money, lunch money. So now all of a sudden, instead of having one sign up, you've got 2, 3, 4, 5. It's this huge, huge halo marketing effect. So what we think is going to happen, and it's already starting to happen, they're bringing in millions and millions of customers through this peer-to-peer payment system first, then they are starting to and will continue to market other financial services like insurance and banking and things like that. And that's where the profitability is really going to come from. So this is an eye chart, but if you look at this $22,500 number, that's sort of like a net present value of what we think a digital wallet customer could be worth if we max out all of those financial services, as well as retail, because retail is still going to be an important component when you think about the usage of digital wallets. Let me explain this eye chart. So in the best case scenario, so let's say we max out this scenario where every single person with a cell phone gets a digital wallet, and we max out the profitability, 250 million times 22,500, could be a $5.7 trillion opportunity. So that's the max pie in the sky. But what if it's just half of that? First of all, what if we just get half penetration across all the cell phones on there? If you have a Apple Wallet, that's a digital wallet. Even if we get 50% penetration and then maybe half the profitability, 11,250 instead of 22,500, that middle number in the top row, it's still $1.4 trillion. And these are just the US numbers. You go one page further, 20 trillion on the max scenario on a global basis, 5 to 10 trillion if it's even halfway successful. Another big, big opportunity. All right, we've got one more section. I'll pause and see if there's any questions on this, and I'll fast forward to the EV slides. Any questions on digital wallets? See, I told you, this deck's normally like 86 pages. We'd be here all day if we actually went through this.
What's the revenue per customer at for digital wallets?
The revenue per customer.
So the cost of acquisition?
Right. It's substantially lower, mostly because they're not making a ton on that period. I don't know what the exact number is, but like for a traditional bank, it's like 3,600. So probably take a rough haircut off of that. So it's going to be insurance. It's going to be banking services. The big opportunity actually is retail of all things. That could be 50% of that 22,500. So if you're familiar with Square, they're now called Block. They're the ones that own the Cash App. There's a very real scenario where Cash App owns the entire retail ecosystem, because you will have the digital wallet and the banking services over here. And then if you've ever been to a small business and they've got the Square reader, or you tap your phone on it, they could own the entire retail ecosystem. And so half of that big opportunity we think is from retail, which the banks is just less important. It's not to say it's not with credit cards and things like that, but that's the big opportunity here.
Does that opportunity include DeFi in the digital wallet?
DeFi is tied to the digital wallets. We actually had a separate section in there. Some people get a little nervous about talking about cryptocurrencies. But yes, digital wallets are being used for all things crypto as a place to hold your cryptocurrency. So there are companies like Coinbase,
Is that in your model?
for example.
Is that in the profitability, taking that into?
We are looking, I'd say in that particular section, we're looking at more of the traditional.
Traditional finance?
Yes, but to that end, ARC is quite bullish on all things crypto. Three big reasons. They have we call them revolutions. There's a money revolution. DeFi is number two, and then Web3, which we already talked about, which is where you get into NFTs. With Bitcoin, there will ever only be 21 million Bitcoins. So it is already a supply constrained asset. So that means where is the demand going to come from? The big opportunity is just, Bitcoin as sort of a store of value, sort of digital gold. We're starting to see more and more institutional adoption. What's going on, or what we've seen in El Salvador and now even in the Ukraine, those are real world scenarios where we're seeing cryptocurrency being used right before our very eyes, in that it is much easier to get money across borders faster, cheaper. People from El Salvador often come to the US, work here, and then send money back to their families via remittances. Well, they often have to use Western Union, and they get charged 8, 10, 12%, and it might get there 3 to 5 days later. With something like Bitcoin, it'll get there in 10 minutes, and maybe it costs you % or two. So it's been really transformative there. And then what we've seen in the Ukraine is donations via cryptocurrencies like Bitcoin, again, because it's that much easier to, I think, get that money across borders. DeFi, for those not familiar, think of this as, it's going to be a technology that's ultimately going to remove the middleman in some parts of the financial services industry. Imagine like the mortgage process. It's pretty invasive when you think about all the paperwork. You got to sign your name 100 million times. One of the concepts behind DeFi is something called smart contract, which is a fancy way of saying if then. You basically code a contract to say, if XYZ happens, execute Y. Well, imagine if you could code a smart contract in the mortgage process to say, if you put up XYZ level of collateral, boom, you get a mortgage. Now, I'm oversimplifying, of course, but that's what decentralized DeFi, decentralized finance, really could do. It could prove disruptive to businesses like that, to any business where there's sort of counterparty risk, so currencies and alternatives and all that kind of stuff. So, but DeFi is a big opportunity, and DeFi plays, if you're familiar with cryptocurrencies, that leans more into cryptocurrencies like Ethereum, and then there's a whole bunch of altcoins behind that. So that we call the DeFi revolution. Oh, hey, EVs. All right, this is it, and then we'll take any other questions you might have here. This is the home stretch. So EV is definitely an area where we're seeing a lot of growth, and if you think about an innovation where shocks to the system are accelerating adoption, what's one of the shocks to the system right now? High oil and gas prices. I heard, it was just a few weeks ago, Volkswagen has an electric vehicle model that is already sold out for the year. And that was a few weeks ago, which was March, right? That's an example of accelerated adoption curves in the face of a shock to the system. All right, we're going to say it one more time, and this is a technology that has everything to do with falling costs. Thank you, thank you, thank you. Far and away, one of the biggest cost components of electric vehicles is the battery. Batteries make up something like 15 to 20% of the cost component of an electric vehicle. And based on our friend Wright's law, one more time, for every cumulative doubling in units produced, the cost of batteries are falling at a rate of 28%. And as we continue to roll down that cost curve, we think electric vehicles are essentially going to be at sticker price parity with gas-powered vehicles here in the next year or two, and then get cheaper from there. And that, you remember I mentioned that leads to powerful tipping points. That is what we're expecting, and I'm going to show you what that looks like here in a couple minutes. As an aside here, EVs are already cheaper on a total cost of ownership basis when you start to think of things like maintenance costs. But the average person does not care about total cost of ownership when they're making the decision at the dealership. It is actually sticker price that is the swing factor for the consumer. So we're going to be sticker price parity in a couple of years and get cheaper from here. And this is what that hockey stick could look like. I kind of teased it earlier. There are 4.8 million electric vehicles on the market today. ARC thinks that that can scale up to 40 million here in the next 5 years. It's a compound growth rate in excess of 50% per year, a revenue association of around $1.2 trillion. The interesting thing here, and I'll leave with this, is we're already starting to see this growth. Last year, gas-powered vehicle sales were up 1.7%, and that's off depressed 2020 levels. Electric vehicle sales were up 112%. Anybody watch the Super Bowl this year? There were quite a few electric vehicle commercials, literally for every single car company that was marketing. That is no surprise. It's sort of the direction that the industry is going. So with that, I'll pause. And maybe first of all, any questions on EVs, and then we can go any other direction you like. Or you can, yes?
With batteries, lithium being a long-term issue, what's the battery evolution, in terms of science? What's the next generation of battery for?
Yeah, it's not only science, it's also cost. We keep coming back to that word. There's lithium iron phosphate, and the issue with the lithium iron phosphate is it can get hot. It can burn up. So I think the EV manufacturers that are using that particular technology, what you're seeing is a whole host of like venting systems that they have to invent essentially. One of the bigger issues near term, again, getting back to disruptions, is partially due to the war in Russia and Ukraine. Nickel is another big component, and nickel prices have spiked dramatically. One of the things we think is, well, first of all, we've seen these commodity boom and bust cycles. It happens all the time, and these EV companies are actually really good at tacking around it because cobalt used to be a bigger component of EVs. The price of cobalt spiked, and cobalt's like run by a bunch of warlords, so it's a bad thing anyway. But the price of cobalt spiked, and the EV companies tacked around. With nickel, one of the things that we think may happen is a move to lithium iron phosphate, which has a couple advantages, not only relative to iron phosphate, but also nickel. First of all, it's cheaper. Second, getting back to our friend Wright's law, it is at a much lower production value than those other metals, and in particular nickel. So what that means is we're going to reach that cumulative doubling that much more quickly, and we will roll down the cost curve quicker. One of our biggest investments, and by the way, compliance, if I talk about a stock, it is not a recommendation to go out and buy that stock. Please talk to your financial advisor before investing in the company. There you go, put my 24 hat on. Tesla is a big investment in our portfolios, and first of all, if that were to happen, I think Tesla's powertrain is just already that much more efficient. Second, Tesla already, I think 50% of their battery makeup is already lithium iron phosphate, so they're already kind of going in that direction. So we think that could in theory go up to like 60 or 70%. So that is the underlying technology we think things are going. One caveat, lithium iron phosphate actually is less energy dense than both lithium iron phosphate as well as nickel, which is a fancy way of saying the range is less. But again, because Tesla's powertrain is more efficient, they don't have to worry about it. And again, they're already kind of there. I think a base Tesla can go like 270 miles. They've got a long range version that goes like 350 and change, and then the high end goes in excess of 400.
So awesome, thank you. Questions?
Do you think they'll maintain their status as the market leader? Do you think that the traditional automakers will catch up?
That's a great question. So if you didn't hear it, so will Tesla maintain their market share? We do, and it's interesting when you look at that page here. 40 million vehicles. Right now, Tesla has upwards of a 20% market share. Our initial analysis was that we were going to see some form of degradation, right, as new entrants kind of come into the market, more kind of into the high teens. And we've since kind of gone back on that. And so the short answer is yes, we do think they're going to maintain it. It's for a very big reason, a specific reason. They are just 3 years ahead of all these companies, whether the new entrants or even the Fords and GMs in terms of production, because it ultimately is going to be a production game. It's not to say, obviously, Ford and GM are going to put a lot of money into this particular business, but right now it's like 3% of their revenues. It's such a small part. It's going to take them a while to get where Tesla is. Meanwhile, Tesla just put up a new fab in, I think it was Austin, as well as Berlin, the new kind of gigafactory. So it's just this huge head start they have. And the other thing we didn't even talk about Tesla is their autonomous capability is also where they're light years ahead of people. One of the smart things that Tesla did relative to other auto manufacturers early on, they hired a bunch of software manufacturers, or software designers. where most auto companies, it's manufacturing mindset. Because AI, they make their own AI chip, for example. So one of the really interesting longer term possibilities with Tesla is either A, they're going to get some sort of revenue off of the autonomous, or you could see them start their own autonomous taxi fleet as well. And again, they're just so far ahead, I think, from a technology perspective. Now, sorry.
How does the Apple Car play into that?
The Apple Car, same thing. They're going to have to ramp up production. Again, it's coming. Like where I think there's going to be a benefit to both Tesla and the entire industry as these companies enter. I think as we have more and more entrants, they're naturally going to spend more money on the infrastructure itself, the charging stations, all that kind of thing. So that's number one. Number two, with new entrants coming into the market, they're ironically going to help us go down the cost curve quicker because again, the total number of production units is going to increase across the industry. That's going to help drive down the cost of batteries and ultimately drive down the cost of cars as well. So in some ways, it's ironically good that I think these competitors are coming in. Yes, sir?
Speaking of new entrants, do you have anybody in mind that might be getting into their able?
So I've heard Brent Wynn, the director of research. Rivian's the one where I heard the technology is really good, but again, it's the ramp up in production I think is so far behind. The other thing is, particularly the Rivians, they're coming in at a pretty healthy price point as well. And not to say that a Tesla's cheap, but Elon's trying to push that price down to make it more and more mass market. So I think that confluence of ramping up production as well as kind of coming in at a higher price point, it's going to slow how many units I think they get on the market. But the technology with Rivian in particular, I've heard is quite solid. The other one we often get asked about is like fuel cell powered cars in this space. And another one where it's in really interesting technology that probably works. I know Japan is putting a lot of emphasis behind it, but it's just expensive. I think if you look at a fuel cell powered truck relative to an EV equivalent, it's like $150,000 more expensive. And then if you look at what it costs to put up like a fuel cell energy power station, what have you, it costs a couple $1 million. And those Tesla power chargers are almost like 10% of that. So they themselves, again, have to kind of come further down the cost curve before that technology is really going to be ready for prime time.
Is the electric grid prepared to keep up with that, with the growth? The electric grid, is it going to keep with the growth?
If it's going to take a while for those prices to come down, then yes, if they can get to price parity, then that becomes a whole new ballgame, I think, because it's so much about the sticker price. And when you think about the consumers hello TV line, the consumers kind of making those decisions, it is ultimately about that sticker price. And until you close, first of all, you got to close that gap, 150,000, right? And then you still have to get cheaper from there. And I think it's going to take them a while. And again, it gets down to production costs. What else?
This is not a shy bunch, so somebody has to ask the question.
Trying to think what else.
Tip your tongue.
We get asked about the recycling of batteries. That comes up a lot. The EV companies themselves, they already have like recycling services. Usually there's some sort of life to the battery. It's usually either 10 years or like 500,000 miles. But some of the stuff I've read is there are going to be businesses just built around that. And I know there's one guy out there, I can't remember the name of the company, he thinks eventually electric vehicle batteries are going to be made 100% of recycled materials, which also partially solves some of the metal issues. So that is something, who knows how long that might take, but that is something we can see in the future as well. Yes, Jay?
It's out of left field, but it's an addition to the grid question.
He's going to set me up.
Randy and I heard about this 3 years ago, Randy, with Brett Wynn talking about crypto miners potentially bolting on the power plants.
Mm-hmm.
And now we saw, back then it was just all laughs. And I guess all of a sudden, a few weeks ago, maybe just comment on what happened up in the Dakotas and what could that mean for the grid?
Yeah, so getting back to our crypto discussion, one of the big knocks on crypto, particularly Bitcoin mining, which it's called proof of work. It's very power consumption heavy, is bad for the environment. And I'm going to come full circle to your question, Jay. I just want to kind of give broader context. What's ironically happened there is it is increasing, the Bitcoin mining is increasing the usage of renewables. It's actually shining a light on renewables in the way we haven't seen it in a really long time. There was a facility, I think, put up in Texas a couple of years ago, 100% powered by solar. El Salvador, who's now using Bitcoin for currency for legal tender, they're using geothermal power to power their mines. The story that Jay's talking about, Exxon, one of the biggest oil producers on the planet, when they burn off natural gas gets burned off and it goes straight up into the atmosphere. They are taking that burn off and using it to power Bitcoin mines. So now, again, it's becoming more and more eco-friendly, and we're using stuff that used to pollute our ecology and actually using it in a very good way. So, good one. He didn't totally set me up for failure on that one.
I have a question.
Yeah.
So one of the things that, you know, I think about 5G technology and how that's changed. So you think about the cell phone, and first, 1G was just voice, 2G was text, 3G, I don't remember what it was, but 5G now is interconnectivity of everything, right? And that's happened, you know, the 1G to 3G took whatever, 20 years. 4G to 5G is taken 5 years. So this convergence of technologies, like how fast is this coming? I know it's here now,
Yeah.
but like in terms of ramp, is this, will 80% of fast food drive-throughs, which I've never been to one before, but will 80% of fast food drive-throughs in 2 years, 3 years, 4 years, how many years before they're all AI?
It's AI in particular, it's that 5 to 10 year window, I would say, right? And it's, you know, some of it has to do with what's going on in the economy now. Again, it gets back to worker shortages. We see it time and time again that when there's a disruption, companies have to get creative. They have to use technology to their advantage. So 2020, when we were locked in our houses, you saw the increased adoption of video conferencing, video streaming, and things of that nature. So, you know, it's the long-term trajectory. It is in that probably 5 to 10 year window, plus or minus. But there are those accelerated adopters that need help right now because they're short-staffed. Now, in the short term, that could eventually be alleviated, right? If we have more workers come to the market. Some of the stimulus money had rolled off, which is why the JOLTS report's getting a little bit better. But we're seeing that right now, where I think, you know, companies need help. So I mentioned, what was it, Flippy, that White Castle's using. Chipotle is using a robot made by the same company called Chippy. So Chippy's whole job is to make tortilla chips. And this is that convergence of robotics and artificial intelligence, and you may know more about this than I do. But if you've ever been to Chipotle and had those chips, sometimes they have a little bit extra salt, or you get a little bit extra lime, and those are like the really good chips. They're programming in the AI behind Chippy to make that happen, to make that a reality, so you still get the same kind of Chipotle experience. But again, they're probably also doing it because they need help. Walgreens, I just saw this week or so ago, they are now starting to use robotic arms to place drugs inside of the pharmacy. So there's 2 fast food places, a pharmacy. It's happening right now. Again, because I think of what's going on in the economy. Again, if we get back to a little bit more full employment, could that ease a bit? For sure, but the adoption curves pull forward. And even if we do have an improvement in employment, it's not like White Castle's all going to say, nah, I don't need this anymore too, right? It's here to stay.
Yeah, it doesn't call sick.
That's true. It does not call in sick. Yeah, I mean, there's so many benefits when you think about robotics, automation, all those kind of things. The term, it's called cobots. It's called collaborative robots, and it's basically robots that work alongside of humans, and that is a big part of the future. Yes, sir?
I don't understand the investment opportunity for 3D printing, so I'd like to hear, just maybe a little more of my question.
Yeah.
So I understand, I think you mentioned aerospace is a potential benefactor, completely understand that. In many ways, 3D printing is kind of democratizing the ability to make components for lots of end users. But I don't know that what you're saying is invest in the company to make this sensor technology, whatever it is that's ultimately 3D printer. And I don't know that you're saying by Boeing either necessarily, because it seems like that would be fairly for the industry. So how are you looking at opportunities for 3D printing?
Yeah, for sure. Another technology that is being accelerated right now because supply chain bottlenecks. That's where we're seeing the adoption. So there's companies like 3D Systems, Stratasys. that are, I would call kind of the market leaders in that particular space. We are now seeing, because of the supply chain bottlenecks, everything from footwear manufacturers, so you can make shoe soles, to supercars, which is just a derivative. So the automotive industry on top of the aerospace industry. So the adoption curve, again, is being accelerated because of that. First of all, the reason being, it allows you to bring the manufacturing of your components closer to home. That is the huge, huge benefit. And not only closer to home, particularly if you were ordering components from overseas and we had all these shipping issues, you're going to be able to also print on demand materials right next to maybe where you're manufacturing your end product, maybe where you're selling your end product. And I had one other thing and I totally lost my train of thought. But it's being used in consumer businesses, aerospace, healthcare. So actually the ability to make tissue, that's going to kind of help transform the healthcare industry. I could go on and on, but a lot of it's just, it's A, easing supply chain bottlenecks, and I think B, ultimately kind of helping save on the cost side.
What else?
Just a question about genomics again. You saw that the scientists in China that got released from prison 3 years to spend there by making twins over
CRISPR babies.
CRISPR babies, right?
Yes.
Essentially immune to HIV.
Yep.
That said, as we develop concepts of designer babies, I only want blue eyes, I only want 6 to 3 guys, as that design concept develops, regulators are in the
Yeah.
field with that. Where do you see this really going, other than the single gene therapy, like
Yep.
sickle cell?
Yeah, that is the big number. So if you haven't heard, there was people in China that literally kind of edited the genome so their kids would have specific traits. That is going to be a no-no. I mean, it's ultimately the FDA is just not going to allow that to happen. I guess I would never say never, but it just seems highly unlikely because it just takes you down all kinds of moral gray area. So the long and short is I don't think it will happen, but it's just because of our own regulation. You know, for a communist nation like China, even to kind of say that's a no-no, I think it kind of tells you where we're going. So, but yeah, right now it's being used in a couple different areas. The CRISPR gene editing, it's what's called monogenic diseases. So when you have a mutation, a single mutation of your gene. The other area where it's also being used is in agriculture. So to increase crop yields, get more people around the world food, and then aquaculture as well, sort of increasing salmon yield. So those are like the big areas. It's the crop area, it's aquaculture, and then it's ultimately kind of curing those bloodborne diseases. But it is a known risk. It's a known issue. It's being looked at very closely.
Matt, you had a question for real this time?
My last question was more of a statement. So, question about EVs. Tesla represents the dead in EVs, but isn't there like a whole ecosystem around electric vehicles that would also warrant some space on the slides? Because Tesla could lose to the combination of all the other big brands because it's brand loyalty.
Yes.
So could you go a click deeper on that?
Yep. So
This feels like we're investing in Tesla, not EV ecosystem.
Well, so again, all right, so we'll go back to we talked about kind of the top-down factors, total addressable market, right? 40 million electric vehicles. What ARC does from a research perspective, once we've identified what that total addressable market is, we tend to seek out the leaders, the enablers, or perhaps sort of the users of that particular technology. So that was us working our way backwards. We know this is a big opportunity, first of all. That's what we had to identify. What is the total addressable market for this market? Then question 2, who is the market leader? It is clearly Tesla. Now, if things change, we will change. So if somehow either Rivian or GM, right, they figure out a way to ramp up production in a big, bad way and they become super innovative, yes, we would switch horses in that particular scenario. We just think it's going to take a while for them to get there. And then the batteries themselves, we don't tend to be commodity investors, investing in the nickels and the cobalts of the world. That's just not the game because it gets you into much more of like a cyclical, you have to pay attention to economically sensitive stuff like that. So we don't tend to invest in anything kind of commodity. But yes, if things change, we will change. That's a whole part of the research, you know. What happens if the disruptor gets disrupted? You have to move on, and that's going to happen over time. You know, who knows? Maybe Venmo gets disrupted, Cash App gets disrupted, et cetera. So it is not a static process, that's for sure.
Any other questions? Thank you very much. Appreciate it.
Thank you so much, guys.